will say what we're here, I'll just give a potted summary of what we're here to discuss, which is taxation, but not taxation itself in terms of how crypto assets are treated for tax purposes, if they're treated as, or if they're taxed as capital gains or as income, for example. Rather, what we're here to speak about is the flow of information on crypto assets and how that information gets to tax authorities so that they can levy the taxes that they want to tax. I think there are two important initiatives in this area, two pioneering initiatives we can talk about. Firstly, at OECD level, and Philip here will talk about that. And secondly, the EU level. I'll ask the speakers to introduce themselves more fully in a minute, but before that, I'll just run through kind of a high-level summary. So the OECD has developed the Crypto Asset Reporting Framework, CARF. This is a standard for reporting, as the OECD puts it, any digital representation of value that relies on a cryptographically secured distributed ledger or a similar technology to validate and secure transactions. And under this framework, the onus is on crypto asset service providers to do the reporting. Tax authorities which receive information in standard formats can then exchange that information. Then we have Lewis to speak about the European Union level, because the European Union has a rule that writes CARF into EU law. Of course, with some additional, I'm not sure we'd describe it as gold plating, but some additional EU specific features. And this has been done through the amendment to the rather blandly named Directive on Administrative Cooperation, or DAC. And that is, of course, a euphemism for the directive on tax authorities getting their hands on the information that they think you're trying not to provide to them. This particular amendment to the DAC on crypto is the 8th amendment. So it's known as DAC8. And DAC8 is in fact not quite final. It's been agreed by EU countries, but they haven't finally signed it off. And I think what was quite interesting about DAC8 is that it was agreed very, very quickly in terms of EU tax law, which normally moves at an extremely slow pace. So EU countries signed up to it about 6 months after it was proposed, and in fact, the European Parliament was caught out because they're supposed to provide input into this process, but they only provided their input after EU countries had agreed to a fait accompli, in effect. So this has caused some friction, I understand. But anyway, firstly, I'll turn to Philip. He can tell us where CARF is at, what take-up there is beyond the EU, and other issues that crypto asset service providers should be aware of. Philip, I understand that in particular there are recent developments in the United States that might be interesting to talk about.
Yes, thank you. I now need to see whether this works. It doesn't work. No, we'll have to borrow the microphone. Thank you, Stephen, and also thank you to Blockchain for Europe to invite me to speak in my hometown on my birthday about the work of the OECD on the CARF. Good opportunity to be at home. Thank you. The CARF, the Crypto Asset Reporting Framework, was adopted in June by the OECD as an international standard, and it was subsequently endorsed by the G20 finance ministers in India, and then afterwards the G20 leaders. I am not going to talk a lot about the past, but just very briefly, why did we do the CARF? This work was done in the context of the comprehensive review that we initiated a couple of years ago of the other automatic exchange standard that we developed, a common reporting standard, which is an exchange standard for automatic exchange for the traditional financial sector. And this standard was 10 years old, and it was time to do a review. And one of the gaps that we identified is that it actually did not comprehensively cover the crypto sector. And so the risk was that all the efforts and progress that we made with the common reporting standard would maybe undone by the rapid growth of crypto assets. And so that's why we developed a separate framework, the crypto asset reporting framework, standalone, separate from the CRS, to fill that gap. I'm not going to go into the details of how it all works, but in a very short summary, it does foresee aggregate transactional reporting to be done by crypto asset service providers. Crypto asset service providers are individuals or entities that offer as a service the effectuation of exchange transactions, so crypto for crypto or crypto for fiat currency. And so they are meant to do reporting to their own tax authorities in the country in which they have a nexus. And those tax authorities will then exchange that information on an annual basis with the country of residence of the users, of the customers. In terms of due diligence procedures, we have tried to mimic to a large extent what we did for the CRS. And we also rely very heavily on the work of the FATF, who has come up with recommendations in the area of the AML due diligence requirements. So that is in a nutshell what this framework does. The technical work is not entirely done. So what we have now is model rules. So these are rules that countries that participate need to translate into domestic legislation to collect the information. We have developed the exchange instrument. One piece of work that still needs to be done is the XML schema for the reporting. And XML is probably for the crypto crowd 19th century technology, but it has done the trick for the CRS, and we hope it will also do for the CARF. Here, the reason why we have a bit of delay is that we want to make sure that we have one schema that can be used by the crypto asset service providers and by governments, both for the CARF and DAC8. We always try to make this one schema to avoid unnecessary divergences and duplicative efforts on the side of business and governments. So that's one piece of work that we still need to do. We hope that that will come out early next year. Then on the technical side, still what we will also do is the after-sales service, which means that if countries start implementing this, typically what will happen is a whole host of interpretative questions will come to the surface. And we do have the habit of working on guidance to make sure that all the participating jurisdictions have a common understanding of the rules, and so that we do not have divergences in interpretation. And this work, also importantly, is done together with the Commission. The European Commission is part of the work at the OECD. So we try to keep this all together. And we do this also with a business advisory group. If you are not yet in that advisory group and you are interested in participating in that work, I would encourage you to come and see me, because we try to get as much as possible input on what are the issues that we need to address, and then also provide, get your input, your feedback on the guidance that we then produce afterwards. There will obviously long-term also be work on the design, where we need to keep an eye on the evolution of the sector. This is actually a horrible sector for us to work in, because we are slow tankers. Getting countries to agree on something takes a lot of time. To give you an example, when we started this work, I think the statistics on how much volume is represented by decentralized exchanges, it was peanuts, we could neglect it. But by the time the CARF was adopted, it is already a significant chunk of the market. So it will probably not have as long as a lifespan as the CRS. It will probably require updates much faster. That's for the technical work, and that brings me now to the most chunky bit of the work that is left, and that is on the making sure that there is a wide implementation of this standard. So it is an international standard, which means that we are also going to try to make sure that this is adopted as widely as possible. A standard like this will only do its work if all relevant jurisdictions participate. If that does not happen, we just create administrative burdens and shift businesses to countries that do not participate in this work. Now, this work is the body that has been mandated to do this is the Global Forum on Tax Transparency, which is a bit of a sister organization of the OECD. OECD only has 38 members. The Global Forum has 168 members right now. They have historically been responsible for implementation of tax transparency standards, and very successfully so. And they now have the task to also make sure that there is a wide implementation of the CARF. And the two key issues that they need to address is, one, which countries will be asked to do this? In the past, for the CRS, that was relatively easy. We identified where are the financial centers, and countries that have a financial center need to participate. For the CARF, this is going to be a bit more tricky. I mean, these businesses are more mobile, less regulated. So it's a challenging issue to solve. And the second question that will need to be addressed is, what is the implementation timeline? I think there is a need to try to come up with a coordinated timeline to avoid friction and level playing field issues. And then thirdly, what in the longer term, what typically is also done for these standards is the development of a kind of a peer review process to make sure that countries properly implement this. I mean, this work at the Global Forum has actually just started, so I cannot give you the sexy number of how many countries are going to do this and what is the date. What I can say is that we hear that a lot of countries are eager to start with CARF, implementing the CARF with first exchanges 27, which is also the date of DAC8. But we will have to see whether this can be reconciled with the need to have a common date, because we need to have as many countries as possible on board. The Global Forum will have its plenary meeting in end November, early December, and I think that will be probably the first moment when we hear a bit more information, potentially also about what we call voluntary adopters, countries that are already indicating that they will do this and by when they will do this.
Yeah, just ask. Perhaps I could just ask. I mean, firstly, it would be interesting to hear very briefly about what's happening in the US, and secondly, is there an issue in this with very small jurisdictions that have the objective of becoming crypto havens or paradises? Is that something that is an issue for you or a concern for you?
On the US, of course, that's also always a hot topic, because most of you know that the common reporting standard is something that was opportunistically built from FATCA, the FATCA rules in the US, and that there is that the US is not participating in the CRS. They do exchange FATCA information. I think here with the CARF, we are in a different. We are in a different situation. I think the US Treasury has not made it a secret that they are committed to participate in the CARF. For instance, the vice chair of the CARF group in the Global Forum is also from the United States. I know that they have come up with proposed regulations in August regarding tax reporting on crypto assets, which are different from the CARF. There are a lot of I think the basic structure looks very similar, but it's different in the sense that it is transaction by transaction reporting, not aggregate reporting. But what they have done in August are actually the proposed regulations for domestic reporting, so for reporting on US taxpayers. So there will need to be a second part coming to implement the CARF, to also make sure reporting happens with respect to non-resident users of US crypto asset service providers. But I'm quite confident that that will happen and that the US will participate on a reciprocal basis in the CARF.
Okay, thank you. We'll turn now to Lewis. So Lewis Calvo is a tax policy officer in the European Commission Directorate General for Tax and Customs. And he's very, very deeply involved in DAC8. So Lewis, perhaps you could just very, very briefly say what's coming next in relation to DAC8 and what crypto asset service providers, who are the ones that are going to be hit by this, what do they need to know?
Okay, thank you very much, Stephen, and thank you very much, Blockchain, for inviting me to this extraordinary panel. I will try to be briefly explaining what DAC8 is, why it is important, and looking forward side where we stand now and what the next steps will be for the next couple of years. So DAC8 is a European directive that what it regulates is the reporting of tax information relating to crypto assets services that concern the reportable European crypto users. So those users that are resident in European members. And it also regulates, so it's twofold regulation, it also regulates the exchange of information between the European tax authorities to allow them to do their job, so verify and control that every tax due is paid. So and continuing linking it with your introduction remarks, what DAC8 does not regulate is the taxation of the gains or the proceeds obtained through the crypto assets transactions. And this is also important because when I talk to anyone about a DAC8, suddenly all of a sudden the people rapidly goes to, you are regulating the taxation of crypto assets. No, we are not doing that. So we just regulate the reporting and exchange of information relating to the crypto assets. That doesn't mean that the European Commission has not organized some meetings with member states to map what they're doing at domestic level, because this is important. We appreciate that there are huge differences between the taxable events, huge differences between domestic legal frameworks, and we thought it is very important for them to discuss those differences and for us to see if in the future we can do something to improve the function of the market, and the taxation itself doesn't affect the market. But why DAC8 is important? When we start drafting the DAC8, we already had a draft of the MiCA regulation. That was very important because that was putting the European Union at the forefront of the regulation of the crypto market. So the European Union was the only region in the world that we were discussing how to regulate the market. And so that was our first references. Secondly, we were also working, we were lucky to participate in the Working Party 10 that Philip is leading with the OECD Secretariat. I also think that the OECD is lucky of having us there because what we are doing with DAC8 is implementing the CARF at European level. So instead of having 27 different implementation of the CARF, we ensure that is one implementation, one goal with the directive. So this is very important. How the DAC8 looks like, I think it's a beautiful piece of legislation. I could be a little bit biased, but it is maybe not perfect, so we don't regulate everything. This is an important point for the people from the practical point of view. When you have something that it is not clearly regulated in DAC8 allows you to go to the commentaries from the OECD, from the Modern Competent Authority Agreement. So you can always use the commentaries for illustration, interpretation purposes. And this is allowed by the directive. So with this, we complete the circle of the directive. Regarding the implementation, as Philip was commenting, we still need to develop the XML schema. We will do it hand in hand with the OECD. I think that would be very much appreciated by the industry because in that way we are creating only one schema that will make life easier for the crypto as a service providers and also for the tax authorities. In this regard, we plan that likely we will organize some meetings with the industry, probably more in the second half of the next year, We will see. We also have some work to do with the member states now that we are entering into the phase of implementing, because member states will need to implement the directive in the domestic legislation. So they also need to do this work, and they will do it with us. Yeah, and you know, I mean, the DAC8 was the political agreement of DAC8 was reached very quickly. It's true. That was because member states, they really were convinced that this was needed at European level. We think it will be formally adopted next month, probably in October. And you know, after the formal adoption, we will have 20 days for the publication in the European Journal. Then it will be entered into force, but the effective application of the directive, the most important provisions of the directive will be applicable from January 2026. And so overall, the message is that DAC8, what intends is to facilitate crypto as a service providers' lives and tax authorities' lives. So we are implementing international standard at European level, just one goal, to make it clear. So what we are providing is legal certainty for everyone to make it easier.
Great, thank you. A question, and this is also probably for Max as well. Do you think that DAC8, do you think there is a lot of unreported information that will in the future be reported? Because obviously the suspicion is that there is a great deal of information. And I'd like to, it'd be great if you could say something about that, Lewis, but also Max, because Max is the Chief Legal Officer at Blockpit, and he's looking at things from the other side to a certain extent, and all the difficulties and challenges of dealing with these regulations. And perhaps you could answer that question, but then talk about the issues that you're particularly concerned about. And I know one thing you're worried about in particular is staking.
Thank you, Stephen. Pleasure to be here. So, good question. Jenny speaking, something I've noticed from a practical point of view. Also, a student lately came up and said to me, after I highlighted that the G20 in New Delhi just emphasized that they want to have a swift implementation of CARF and DAC8, or like CARF in this regard on a global level. How does this impact me as an individual trader? So we have been talking about CARF and DAC8 implementing reporting standards on the service provider level, and then a framework for automatic exchange between countries. Does that mean we will implement a single tax regime globally? No. De facto taxation will be still up for each and every member state, for example, in the European Union, or also internationally for each jurisdiction to decide how they want to tax people. Therefore, there is still, of course, like the question that you asked before about tax havens. If this will result in tax havens, the answer is it will kind of stay the same as it is right now, because the reporting obligations per se don't change the de facto taxation in the individual countries. So how does it affect the individual though? And this is also about the question, what does CARF cover? What does DAC8 cover and what doesn't it cover? So one of the key objectives when CARF and DAC8 were negotiated was that tax transparency in general should be higher. With crypto taxation, we see that there is not a lot of tax transparency. We see that there is a lack of information on the state level, that NCAs don't have enough information to actually effectively enforce tax law. The tax audits are practically not implementable at the moment because tax authorities lack information. So what CARF and DAC8 do? They oblige service providers to report the tax information of the users to the NCA, so the national competent authorities. So still, CARF and DAC8 both don't cover DeFi for the most part. They don't cover peer-to-peer transactions. What they do cover, though, is transfer of crypto assets to, for example, self-hosted wallets. So this would be covered. Why? The reason being that CARF and DAC8 mainly focus on the on and off ramp against fiat. So every time I want to cash out, so to say, I need to go through an entity that is obliged to report under CARF or DAC8. Therefore, the government will actually know that this person is holding crypto. And that's a significant step, because now at least they know, do they hold crypto? So we saw that in the US. Your question about the US, for example, on the level of de facto taxation. So I think it was in 2016 or 2017 when the US introduced one little tick box, do you hold crypto, yes or no? And tax transparency increased by 4,000%. Same in Australia when they started to write letters to their taxpayers asking, do you have crypto, yes or no? Suddenly people said, oh, that's important from a taxation purpose as well. So we need to be honest here, because otherwise we will get criminal charges and have severe consequences. And so I think what CARF and DAC8 will do, it will increase tax transparency by giving national authorities the knowledge of who holds crypto. So this is a big step. When it comes down to DAC8 and its practical implications, or like also the differences between DAC8 and CARF, I may refer to the presidency compromise from 5th of May this year and some parts of the comments that were just adopted by the European Parliament last week. So in contrast to CARF, DAC8 contains crypto asset services under DAC8 are those services that are referred to as crypto asset services under MiCA, including staking and lending. So we have also staking and lending referred to as crypto asset service in DAC8, meaning that providers of staking and lending will have to report under DAC8, whereas maybe they are not even subject to MiCA or to TFR. Why is that a problem? DAC8 is a directive, so it has to be transposed by each and every member state in the European Union, and therefore the member state that implements it and transposes it to national law has a certain room for interpretation. The issue is that within DAC8, staking is not defined. Therefore, it leaves a lot of room for implementation, because as we know, there is different forms of staking. 2 days ago, we published a paper on what actually can be seen as like different forms of staking, technical staking. Then also you have so-called SINOs, which means staking in name-only activities, where certain processes would be referred to as staking, but in fact they maybe constitute something different if you look at the underlying technical process. So that's a very, very important point also when it comes down to the question of, is DAC8 gold plating, yes or no? Then another important implication of CARF and DAC8 on the practical level is, we have been talking about this international framework of automatic exchange. Therefore, the Commission in Europe and the working groups at the OECD level are called upon to implement the XML regime for the automatic exchange of data. The issue that we see is service providers will have to report their data first to the governments before they can exchange it amongst each other. So there is no technical standard of how service providers should report the information to the national competent authorities and how this should be done in accordance, for example, with GDPR. And this is a very, very important topic because, as everyone knows, taxation is highly sensitive financial data. So a lot of states really worship the tax privacy principle of their own tax base, and therefore practical implementation still leaves a lot of rooms for quite like a lot of questions open. And maybe last point I wanted to mention also, because this was now like the European Parliament actually proposed an amendment here. If it's going to be adopted, remains to be seen. Very unlikely in the usual consultation process, but this is something which is already foreseen at the level of the OECD's CARF. So service providers that are obliged to report have to evaluate on a case-by-case basis if a crypto asset can be used for investment or payment purposes. Why is that an issue? They have to do that on a case-by-case basis and adequately determine, it's what CARF and DAC8 say, if it's an asset that is used for investment or payment purpose and is therefore reportable under DAC8 or CARF. What will practically result out of that is that most service providers, which will just qualify each and every asset as reportable, so that they avoid potential penalties, right? So I think maybe that's also a way to go, because then you get a more holistic picture, right? You get more assets actually reported. But this case-by-case evaluation is something we saw quite problematically from a practical point of view.
But perhaps we could just put that over to Lewis. I mean, are there things you can say that would sort of put Max's mind at rest on these issues?
On this,
And I would also, sorry, Lewis, just before you answer that, I would also say that it'd be great to have some questions from the floor as well. So if anybody is out there with a burning issue that they want to mention, then, you know, please start to put your hands up and let it be known. But I'll turn to Lewis first.
Okay, regarding staking, would be that staking and lending, it's true that the DAC8 in the definition of crypto as a service, it is expressly including staking and lending. I would agree with you that it would be good for legal certainty to have a legal definition for those, which now it's, I wouldn't say it's lacking, but it could be put more white on, black and white. But regarding this, I have to say that if you look at the definition of reporting crypto as a service provider, the activities that they have to perform are those that are effectuating exchange transactions by or on behalf of reportable crypto users, which means that if a reportable crypto as a service provider, it's only providing the services of staking and lending that will not be obliged to report those activities. But if you are under the definition, so you are defined as a reportable crypto service provider, because you are doing more activities, and including staking and lending, those would be considered activities that you have to report under DAC8. Why is this? Because even though it is not regulated, at least in MiCA, what we could all agree is that from staking and lending, people can obtain some certain gains. And those gains are interesting from the tax perspective. So tax authorities, what they want is this information, and they will decide if this is taxable events or not. What we are providing is the opportunity for the tax authorities to get this information. But with these nuances, I just explained. Yeah, and I don't know if you want to any other.
I mean, like just answer quickly to that. I think like staking and lending would have been covered anyways, because it's also covered under OECD's CARF.
Yes.
But it's not covered on the level of obliged entities, but on the level of of transactions. So basically, the service providers have to report on an annual basis the aggregated amount of like in and outgoing transactions, the value of them, etc. So they also, in instances where they know, have to report the type of transaction. So if this, for example, if there's proceeds resulting from staking and lending, they have to say, okay, this is proceeds from staking and lending. So it would have been covered by this reporting obligation anyways, but I just see that defining it as a crypto as a service, just like I said, would go beyond TFR and MiCA. But we will see what the council will do. Most likely will stick and staking and lending will stay in there. But yeah, like you said, I think ultimately, and this is something which is very important for the industry as a whole, because we were just discussing that prior to our conversation, to our discussion round right now, that overall taxation in a sense of crypto assets is something which has barely been discussed. We see it each and every compliance session. Everyone's talking about AML and financial crime measures, but never about taxation. The reason being that there is a lot of solution providers. We see it here. There's some sponsors here as well that are very established already and have built a lot of knowledge within national competent authorities on how to do AML checks, sanction checks, and financial crime checks properly, and to actually also execute them properly in the practical area. However, when it comes down to taxation, up until now, there's barely any government that actually can effectively enforce tax law. Even within Germany, for example, this was there was a case that went up to the highest financial court in Germany. If there was a question if crypto tax would actually be a valuable law, so to say, because it couldn't be properly enforced. The court said, yes, it is a law, so people also that didn't pay the taxes back in 2016, 2017 still have to pay them. However, there is a lot of discussion going on if taxation is even a matter that can be effectively enforced, because governments still lack the education, I would say, on the one hand, and other sides, the technical possibilities in order to effectively execute this. And this is where I, as a taxation guy, so to say, not de facto taxation, but reporting guy, I see a lot of value in CARF and DAC8, and also an opportunity for us as an industry, likewise to the likes of TRM and Chainalysis, to educate law enforcement on taxation, and how this can be implemented from a practical point of view. And ultimately, this will also get greater legal certainty, legal clarity to the overall crypto field, crypto space, more legitimacy. Because right now what we see is that often crypto is associated with tax fraud and tax evasion. It's not necessarily a money laundering anymore, or like sanction evasion, because this is what we see, for example, from the Chainalysis global reports each and every year, that the numbers here are very low. Yeah. But then again, with taxation, I mean, in a lot of countries, there's zero tax on crypto assets. So.
Yeah. We're coming to the close now. A couple of questions have popped up, and they're kind of linked. The first is, will DAC8 requirements make EU-based crypto assets less attractive to global investors? And the second is, could DAC8 inadvertently drive crypto businesses to jurisdictions with less stringent tax reporting? It might be interesting to broaden that out slightly and kind of go back to what Max was just saying. Do you think that this shining a light on crypto transaction and asset information for tax purposes, will that actually have a knock-on effect on crypto itself? For example, you could think of a small investor, you know, who might be trying their hand at crypto. They might be deterred and prefer to put their money into something else if they know that they're going to be exposed doing this. Maybe that's a very cynical view, but so do you think that there'll be, firstly, impacts on investment or crypto in the European Union, or more generally, maybe we could ask you first, Philip.
I don't know what the answer is to that question. I do know that there are studies that have been done in the past that if once you introduce third-party reporting, the compliance rate is increasing tremendously. Once the taxpayer knows, that the tax authority knows, then there is more compliance. Maybe not exactly an answer to your question, but I think there is also, we are talking now about the framework that brings light to the transactions, but there is more work to be done by countries. If it comes to the light and taxpayers are incentivized to comply, they also need to know the correct tax regime, and there is a lot of work still to be done also by countries to make sure that there is clarity about what is the tax treatment of these various transactions. And then also what we see when we have done that at the time of the CRS, these are when you introduce a reporting framework like this, these are good moments to also think about voluntary compliance initiatives. And we have at the time of the CRS come up with guidance on how can you design a good voluntary compliance initiative so that you are bringing the taxpayer into compliance without imposing excessive sanctions. And it's maybe a good moment to take that away, the dust away of that report that we did in 2013.
And the same question to you, Luis. Do you think there are risks?
Yeah, for the individual investors, what I would say is what I said at the beginning. It's that we are providing legal certainty. Tax authorities will receive this information, which will facilitate their work. But if in the case that the DAC8 or CARF will not exist, they will get this information from other means, which means that taxpayers will need to report this information by their own means, making their lives very much difficult. So we are making their lives easier by putting this report obligation on the crypto as a service providers, which they already have this information. They will automatically, with this schema that we have to develop, they will report this information for the tax authorities, and the tax authorities also will receive this information in a very much easier way, that they will be able to verify their taxpayers in a easier way. So I think from that point of view, it is justified to have the CARF and the DAC8. On the possibility to go abroad and conceal the information, and I will agree with Philip, what can we do now? I mean, there's always a possibility for that, even for the serious. We have all kind of examples that the people who wants to conceal the information, they will find a way, but they will always be first pursued by the tax authorities. Second, they will not be protected by the market regulation. So that's also a risk for them.
Yeah. And Max, do you think, do you agree? Do you think DAC8 and CARF makes people's lives easier?
The question is, does it make life easier? That's a very, very good question, actually. I agree with both of you, what you said. So we see that CARF and DAC8 will implement a system of checks and balances. So in the European Union, for example, the liability to report tax on crypto asset transaction was up to the individual in every state, up until now, right? Then now it will be also service providers reporting to the NCAs, creating a more holistic picture of who actually trades crypto. So this will, of course, for this third-party reporting will increase compliance. Does that mean that people will leave the European Union because it's a competitive disadvantage? I don't think so. Looking at the United States have implemented the 1099 regime. I mean, it's not as holistic as CARF or DAC8. However, it's of course already some kind of reporting mechanism that is in place. And we see that tax honesty and tax transparency in the United States is actually on average way higher than it is than in the European Union. As a very simple mark I can give you in this advance is, for example, tax solution providers. In the United States, you had like 3 years ago already 3 or 4 unicorns. So taxation solution providers that had very high valuation because the demand was very high. They had a lot of traction, etc. Back to the question, does it make life harder for people in Europe? I think yes, in a sense of, okay, now I actually have to declare my taxes and the government can verify or like at least review to a certain extent, did I declare the right amount of taxes? The issue is that when it comes down to crypto taxes, this is something which is really, really difficult to handle from a practical point of view. We see tax solution providers popping up everywhere, offering cheap solutions, which then would be submitted to the government, and you get like you use 5 or 6 different tool providers, and each and every one gives you a different output. And I think that's an issue right now, because like if you as a customer can't even trust that the solution that you're using is giving you the right output, then how can I file my right taxes with the NCAs, right? So I think this is the point where there's still a lot of work to be done to have trusted providers that can actually do the tax declaration for crypto asset traders in a way that is reliable and also verifiable on the government side. So and for service providers that have to report now under DAC8 and CARF, most of them are already obliged under the AML regime to report a lot of the information that has to be reported under DAC8 as well, because DAC8 consists mostly of 2 bubbles. On the one hand, it's the KYC part. So it's all the person-related information that has to be reported, which has to be reported under AML as well, because most of them are virtual asset service providers as per se the definition of the FATF. And when it comes down to the tax relevant user information, yes, this of course will be something which is an additional compliance burden for the service provider. However, OECD's CARF will implement that on a global scale. And saying what Lewis, I can just agree with that, is that if I want to avoid paying taxes, I can avoid it. I don't even have to file a wrong tax declaration. I just move to the right country, because some countries just don't charge taxes on crypto. However, ultimately, coming from a country which has one of the highest tax rates in the world, we have a tax rate up to 55% income tax. As an employee, I would get maybe like 35 to 40% of my income because of social care, health insurance, etc. It is not a bad thing to pay taxes. It's a good thing. I'm from Austria. Austria is considered one of the richest countries in the world, one of the most safest places to live in. The reason also is because we pay that much taxes. And you see what happens if that's not the case, like in the United States, where you have a big discrepancy between like rich and poor. So tax has its purpose. And I don't think that we should look at it as something evil, but kind of like make it a bit more something more to love.
Yeah.
By saying it gives us a better together in our countries.
I won't even go into the Belgian case for in high taxes and services, but we're running over time now, and I'm sorry about that, but I will. Tommaso, is that okay? Just I see a question at the back of the room there, so if it's possible to squeeze just one in, that would be really great. And if you don't mind introducing yourself, that would be a great help. And if you want to direct the question to a particular person as well.
No, it works, yes. Christoph Bond, Swiss Finance Council. If I'm not mistaken, there is an equivalence regime under DAC8 for non-EU operators to avoid they have to register in the EU if they want to provide business to EU clients. And I would like to know if they apply the OECD framework, CARF, will that be considered as equivalent under DAC8? I don't think we have answered that question clearly now.
That sounds like one for you, Lewis.
That's a very good question. It's very good news that, as Philip was explaining, that it will be under the Global Forum, the implementation of CARF, but that's something that the latest step the Commission will decide. So I cannot now commit the Commission as such to say that if it is revise the Global Forum, it will be everything done and it will be correspondent for the DAC8. That's something that will be decided. In any case, the Commission will revise also the non-European Union jurisdiction regime to ensure that it is correspondent with the DAC8.
Would you have anything to say on that, Philip?
I agree with Lewis that probably an important element in there is the work that the Global Forum does, because the Global Forum makes sure that it is not a paper standard, but it is a standard that is applied properly in practice. So they do now, for the common reporting standards, they do peer review. So countries are looking at each other, whether they are properly implementing, whether the legislation corresponds to the standard, but also whether it has been effectively implemented, whether there are compliance reviews being done on the service providers and so on. And I think that is probably also important in giving assurance to the Commission that the rules are equivalent to those in DAC8.
Okay, I think we do, unfortunately. I think Max wants to say something. Is it super quick?
Yeah, maybe just to that. So yes, each and every crypto service provided that services European Union citizens for tax purposes on a reverse solicitation basis has to report on a DAC8 as well, which makes sense. Because if I am a crypto trader and I use, for example, a crypto exchange which is based on the Bahamas for trading, And this would result ultimately in me not having my taxable gains being reported to the NCAs. It would be unfair because then it would be a competitive disadvantage for all the European Union-based service providers because no one would trade with them anymore because then they report to the NCAs, whereas the international counterparties don't have to. So it just only makes sense to have these mechanisms in place. The latest draft of the DAC8 proposal foresaw that service providers can rely on other service providers' information if they verify that this information that they reported was valid. This was cut out in the last draft, which I think is actually a good thing because how should a service provider verify if the information reported by another service provider is valid? So now each and every service provider has to report. It will hit everyone that serves European Union-based clients in the same way. So there's no competitive disadvantage neither for European-based service providers nor for service providers that are from abroad. And what we want to prevent from happening, and what I think is a very, very good approach that we also have to make to ensure in MiCA that happens with the implementation, is that we prevent a race to the bottom. Because this is something that we have seen, especially in the area of taxation, where there is a race to the bottom, that service providers go to those countries with the least stringent reporting requirements. Therefore, it's important to have a minimum standard, and this minimum standard will be agreed upon at the OECD level.
Great. I think we're way over time, and I'm sorry about that. And we have to wrap up. But thank you very much to Philip, Lewis, and Max for a very enlightening discussion. I'll hand back over to Tommaso.